Hey tech-savvy listeners, welcome to the Friday edition of Tech Stocks Daily, where we break down the biggest market moves faster than you can say NASDAQ. Today, we dive into Apple's $900 million tariff tackle and its global manufacturing pivot that would make any chess player proud. Roku's future shines amid slowing growth predictions, and we'll squeeze out the juiciest bits on why analysts are still placing their bets. Lastly, Kyndryl's preparing for earnings amidst legal turbulence. Get ready for a roller coaster of earnings highs, tariff troubles, and strategic shakeups that will keep your earbuds buzzing with insight. Stay with us, and let's decode the world of tech stocks together. Hold on to your hats, tech enthusiasts, because today, it's all about Apple. The mighty iPhone-wielding titan found itself in the spotlight once again, dropping some significant news that got both Wall Street and Silicon Valley buzzing like bees in a gadget-laden garden. First up, Apple shares experienced a bit of a slip and slide, dropping nearly 4% this morning. Despite the general uptrend in the market due to positive US-China trade negotiations, Apple had its own hurdles to jump, tariff troubles, to be precise. CEO Tim Cook dropped the bombshell that the company anticipates a $900 million hit due to ongoing tariffs. Cook elaborated that Apple's production strategy is undergoing a tectonic shift, think global manufacturing marathons, by moving a significant portion of iPhone production to India, leaving Chinese assembly lines with fewer iPhones to crank out. This move is seen as a shield against Trump's tariff policy, which zapped Chinese imports with a shock of up to 145%. As a result, Apple is diversifying it like a tech-savvy squirrel stashing gadgets in multiple foreign forests. Gazing deeper into the Cupertino crystal ball, Apple released its recent earnings report, showcasing impressive results that surpassed analyst expectations. The tech juggernaut pulled off a $95.36 billion feat in revenue this quarter, edging past economic wizard predictions of $94.53 billion. That's no pocket change, mind you. iPhone sales hit $46.84 billion, showing a neat boost from the same quarter last year. Their services business, from Apple's Pay, iCloud to Apple Music, generated a jaw-dropping $26.65 billion in revenue. But here's where the plot gets as thick as a digital book. Despite the stellar earnings report and an enviable array of financials, it's the big bad tariffs looming over that have kept investors on the edge. Although Apple has announced ambitious plans for investments stateside over the next several years, they're also wrestling with the impact of these trade hurdles, which could lead to escalating costs, potentially spiraling iPhones to a cool $3,500 if made in the US without technological aids. Apple didn't stop at just moving factories. Tim Cook expressed aspirations for advanced robotics to lend their cyber hands in US manufacturing. This pivot points to a future where advanced manufacturing techniques like precision robotics could sidestep labor costs and keep iPhones as affordable as digital dreams. In the ETFs world, Apple's performance made waves too. With major tech ETFs holding hefty Apple stakes, the news saw them balance Apple-heavy portfolios on trade worries tightropes, all without much wobble. As we stand, these developments spell a tale of prominent revenue highs, foiled by tariff troubles, strategic production shifts, and increasingly pricey supply constraints. Truly, an Apple a day keeps the financial press in constant play. All right, folks, let's dive into the latest buzz surrounding Roku. It has been a whirlwind of a day for the streaming giant, and there's plenty to unpack. Let's break it down into digestible nuggets. First off, Roku caught the market's attention by issuing a rather sobering second quarter sales guidance. Instead of the anticipated $1.9 billion, they're predicting $1.07 billion. Now that might look like a measly difference, but in the high-stakes world of tech stocks, every million counts. They also adjusted their full-year sales outlook down to $4.55 billion from $4.57 billion. Basically, they're giving heads up that times might be a bit tighter than everyone hoped. This, combined with ongoing tariff-related uncertainties, stirred a bit of skepticism among investors. But it gets deeper. While Roku's charming first quarter performance had the figures crunchers feeling warm and fuzzy, boasting 16% revenue growth and a 37% leap in adjusted EBITDA, it didn't translate into market cheer. Why? Because the company expects things to taper off, projecting second quarter revenue growth to decelerate to 11%, while device revenue is expected to decline by 10% year over year. They've basically told the investors, enjoy it now because the pace won't last. Many analysts reacted quicker than a caffeinated Starbucks corporate lawyer, adjusting their price targets and giving mixed signals. Barton Crockett, one of the analysts, stuck to a neutral rating but chopped his price target from $100 down to $75 due to slower growth projections and their impact on stock valuation. Others, however, remain bullish, like that one friend who always bets on the underdog, naming Roku as a top pick for 2025 for its potential resilience and its diversified revenue streams that rely less on media and entertainment direct buys. The silver lining? Roku's snappy growth in its platform revenues. They reported a sweet 17% increase in the first quarter, slightly outpacing their own guidance of 16%. Even with a touch of margin sensitivity, Roku reaffirms its full-year guidance, signaling they have a confident eye towards expansion and future profitability. Their juicy acquisition of Friendly TV is also expected to bump up their future earnings. In case you're worried about Roku's survival skills in the vast streaming savanna, remember this: Roku doubled down its innovations with enhanced targeting and programmatic ad capabilities. This positions them well amidst evolving advertiser habits, keen on flexibility and tangible returns on investment. So, there you have it, a roller coaster day for Roku. The company's current stock dip might just be the storm before the calm, as they stack up strategy changes and gear up for what they believe will be compelling growth in the years to come. Keep those eyes peeled, because this saga is far from over. Kyndryl, the IT services giant, is making headlines today for two major reasons, drawing considerable attention in the tech and investment worlds. First up, Kyndryl is gearing up for its Q4 fiscal 2025 earnings report on May 7th. Over the past 4 quarters, Kyndryl has been a bit of a surprise package, averaging an earnings surprise of 60.5%. This time, though, the tea leaves aren't so optimistic. The Zacks consensus estimate predicts a revenue dip of about 1.9% from last year's results, attributed to Kyndryl stepping back from some less than stellar revenue streams. Despite these challenges, the estimated earnings have taken a positive turn. Kyndryl is anticipated to report 52 cents per share, a vast improvement from last year's penny per share loss. The driving forces include the company's consulting ventures, dubbed the 3 initiatives, and efforts to keep expenses in check. However, speculation suggests this might be the first time Kyndryl fails to beat expectations in a year. On a separate and dramatic note, Kyndryl finds itself in legal headlines. The Rosen law firm is investigating potential securities claims on behalf of Kyndryl's shareholders. This drama started when Gotham City accused Kyndryl of manipulating financial metrics, including adjusted EBITDA and free cash flow. According to these allegations, while Kyndryl might appear financially healthy, it allegedly masks a backdrop of losses and cash-burning scenarios. This explosive revelation sent Kyndryl shares on a downward spiral, creating anxiety among investors who are now being pushed to contact Rosen law firm to explore potential class action litigation for compensation. With these two stories unfolding, Kyndryl is under the microscope for both financial performance and ethical practices. Whether it's witnessing how the financials will pan out post-report or the anticipation of legal repercussions, Kyndryl's current situation exemplifies the dual nature of business in the tech world, promising opportunities coupled with crucial challenges. Now, let's hear from you, our audience. What do you make of Kyndryl's current scenario? Are you expecting them to bounce back with their earnings report, or do you have concerns about the legal allegations they're facing? Drop your thoughts in the comments below. We love engaging with your insights and predictions. And as always, keep the discussion lively, folks. Your insights not only help the community stay informed, but also bring a diverse perspective to ongoing conversations. Whether you're a Kyndryl cheerleader or sitting skeptically on the sidelines, every opinion counts. Let's decode this tech puzzle together. All right, tech stock enthusiasts, let's shine the spotlight on Apple for this segment. Given the news today, if I were in the position of trading stocks, here's what might influence my decision-making process regarding Apple. To hold. Why hold? Well, here's the juicy core of my thought process. Firstly, despite the stock sliding nearly 4% due to tariff concerns, Apple remains a behemoth in the tech world, shattering its revenue predictions for the quarter with a cool $95.36 billion. That's no small feat. And while tariffs might seem like daunting clouds on the horizon, Apple's strong fundamentals give a gold-plated cushion against short-term turbulence. Furthermore, Apple's strategic pivot to move more iPhone production to India in response to tariffs suggests a savvy, forward-looking operational strategy. It's like watching a pro gamer adapt in real time, with Apple shielding its flank against future trade hurdles. The potential implementation of advanced robotics in manufacturing could further amplify its long-term profitability by managing cost uncertainties and maintaining competitive pricing. On the macro level, Apple's robust ecosystem, iPhones aside, continues growing like a well-watered tech tree. Their solid investments into U.S. core economic interests also provide a blend of goodwill and potential political cushioning, a factor that'll keep investors interested. Of course, here's a gentle nudge to every listener out there. Make sure you're doing your own research too. My insights are based on today's snapshot, and stock decisions should weigh personal financial goals, risk tolerance, and various comprehensive analyses. Stocks expand like roller coasters, complete with ups, downs, and personality-infused market shifts. Dive into the details, keep the conversations going, and make informed choices that suit your strategy. Happy investing. All right, folks, what a day in the tech realm. We've seen Apple playing some serious chess against tariff troubles, Roku smoothing out some future rough patches, and Kyndryl juggling earnings anticipation with legal tension. If today proved anything, it's that the NASDAQ tech titans are navigating some roller coaster-worthy twists and turns. Now, if you enjoyed today's whirlwind tour through the tech stock world and want more of this snack-sized, info-packed content, make sure to like this video, subscribe to the channel, and hit that little notification bell. Share it with your buddies who love talking numbers over coffee. Relax and recharge over the weekend, because we'll be back at it on Monday with another snapshot of what's shaking in the tech world. Enjoy your weekend, tech troopers, and keep innovating on those ideas, big or small. Stay techie and stay awesome.